Hello, my name is Harrison Rainwater, and this is an industry comparison between 5 companies from the oil and gas industry and 5 companies from the electrical services industry. By analyzing some key financial ratios, I will choose the best option among the 10 companies as a whole. From the oil and gas industry, I chose ExxonMobil, Cabot Petroleum, Apache Petroleum, Anadarko, and Unit Petroleum. To begin, we look at the financial leverage of these companies. With a range of 1.8766 to 2.55, Unit has the lowest amount of leverage among the group. Their year-end value is higher than their 5-year average, seen mostly since 2011 till today. Apache uses the most leverage and seems to be increasing that number over time. Exxon is barely above its 5-year average and seems to be maintaining at a lower leverage on average. Cabot is slowly adding leverage with the second highest rate of 2.21, also above its 5-year average. A look at times interest earned shows that Exxon has the greatest ability to afford its debt by a large comparison. This is mostly due to their lower amount of leverage compared to the size of their company. Unit has the second highest times interest earned ratio, but only increased its rate as of 2013. All of the other companies seem to be close to their average and relatively stable, but less in comparison. In analyzing turnover, Cabot has the second highest turnover and seems to be the only company which is increasing its turnover over time, most notably since 2012. Exxon, Apache, and Unit seem to be increasing their turnover since 2011, seen by their lower than average year-end turnover values. Anadarko, the only other company with an above-average year-end value, seems to be actively working toward increasing their turnover over time. Apache, Anadarko, and Unit were all apparently hit hard by the financial crisis and haven't made it back to their original productivity levels since. Apache, who was hit the hardest, dropped almost 1,000% in 2009 and has barely increased its productivity since. Anadarko, who hasn't stopped decreasing turnover since 2009, has the lowest year-end value but is surprisingly above its 5-year average. Since 2012, Unit has made a huge comeback in productivity levels, doubling the productivity lost in 2009. Exxon has the highest year-end value, however, is below average due to their decreasing productivity since 2012. Cabot has seen a large increase as well as almost 100% since 2012. They have the highest second year-end productivity value and are above their 5-year average. Next, we look at a breakdown of the company's return on equity. Exxon has the highest return on equity of a 19.17, which seems to be driven by having the highest turnover and a healthy amount of leverage. The high turnover is good, but they also have the lowest operating margin. Cabot has the second highest return on equity of 19.9 compared to Exxon. They have 3 times the operating margin, but less than half the rate of turnover. They also use a little higher leverage than Exxon, but not by much. Cabot has a high but lower operating margin than Cabot, and also uses a very small amount of leverage as well. Unit has a return on equity of 8.92, which seems to be driven by a turnover that rivals Cabot and a fairly high operating margin. They use a very small amount of leverage in comparison to the other companies, but as we saw, they seem to be making efforts to increase this, which should help magnify their return on equity. Anadarko has the lowest return on equity of 3.7, which is being driven down by their large leverage and operating expenses. Next, we analyze the price-to-earnings ratio for the measurement of marketability. Exxon has the second lowest value, is above its 5-year average, but decreasing over time. Cabot has the highest price-earnings ratio, and it seems to be making efforts to increase this. Unit has similar momentum as Exxon, however, they're above their 5-year average in comparison. Anadarko has the second highest price-earnings value, but is significantly below its average. And Apache looks as though they have been decreasing their price-earnings ratio over time. Finally, we'll look at the company's cost of capital, their return on their invested capital, and their economic value added. Unit has the highest cost of capital and a slightly negative economic value added. Anadarko has a high return on invested capital, a positive economic value added, and they pay the highest cost of capital. Apache has a very largely negative economic value added, that's forcing them to have a very low return on invested capital as well. Cabot has the highest return on invested capital, they pay the least for their capital, and they have a positive economic value added. Exxon has the highest economic value added among the group, with a low cost of capital and a normal return on invested capital. So who do we like best? The winners of the oil and gas industry are Cabot and ExxonMobil. Exxon shows promising stability with a much higher return on equity value for a much lower amount of risk. They have a good turnover rate, but they also seem to pay high operating expenses. Cabot seems to be acting as a growing company based on its return on equity and high price-earnings ratio. They're slightly more levered than Exxon, helping them keep their return on equity so high. Next, we move on to look at the electrical services industry, and from here I chose Entergy, Cleco, DTE Energy, American Electric Power, and NextEra Energy. With a leverage range of 2.71 to 4.6, Entergy seems to be using the highest amount of leverage, with Cleco using the lowest. All of the companies appear to be decreasing their leverage over time, which is expected as the values at year-end 2013 are relatively high. American Electric, DTE, and Cleco seem to be decreasing their leverage at a faster rate. As you can see, their year-end values are lower than their 5-year average. Consequently, when looking at times interest earned for these companies, American Electric, DTE, and Cleco have year-end values above their 5-year average. It seems that the choice to decrease their leverage at a faster pace has paid off, as they have a better ability to afford their debt in comparison to NextEra and Entergy. In terms of asset efficiency, the only company with a year-end value above its average is DTE. Their turnover has been volatile over time, but they saw a strong increase in 2013. NextEra and American Electric seem to be decreasing over time and are below their average. Cleco and Entergy have the same year-end turnover, but Entergy seems to be below average and looks to be decreasing at a faster rate. Next, we take a look at productivity based upon return on assets, and it shows that Cleco has the highest year-end average, but their year-end value is below that by 0.36. They seem to be decreasing over time, but not by much from the large spike of productivity that they saw in 2009. Entergy, on the other hand, seems to be decreasing productivity over time and is below its 5-year average by 1.1. DTE is the only other company above its 5-year average and did not suffer as badly as most companies in 2012. American Electric and NextEra are both below average and decreasing productivity over time, thus leading to the return on equity breakdown. So when we're breaking down the return on equity, we see that NextEra has the highest return on equity of 11.19, which is being driven by a high operating margin and a high use of leverage. They fall short in turnover, however, with the lowest value of 0.23. Cleco has the second highest return on equity of 10.42, but seems to be driven by better numbers in comparison. They have a high turnover, a high operating margin for a smaller amount of leverage. American Electric has a return on equity of 9.95, but is driven by much more leverage than Cleco. DTE has a return on equity of 8.64, but is driven by much more leverage than both companies combined. And Entergy has the lowest return on equity of 7.56, which seems to be obviously driven down by their low turnover, their low productivity, and their very high amount of leverage. Next, we look at the price-earnings ratio for each company. Cleco has the highest price earnings and is above their 5-year average and seems to be increasing over time. NextEra looks like it's moving at a similar rate as Cleco, but at a faster pace. DTE is increasing by a smaller amount than NextEra and Cleco, and Entergy is growing its price-earning ratio at the slowest rate with the lowest value. When we look at the cost of capital for these companies, we see that American Electric and NextEra both have very high economic values added to their companies. They also make decent returns on their invested capital and pay a smaller amount for capital in comparison. Cleco has the highest return on invested capital, a positive economic value added, but pays the highest percentage in cost of capital. Entergy has a higher economic value added and pay less in cost of capital than Cleco, but their return on invested capital is much lower. DTE is the only company with a negative economic value added spread and the smallest return on invested capital. So who do we like best from the electrical services industry? The winners are NextEra and Cleco. NextEra seems to be a good company for their high leverage and high times interest earned. They have a high operating margin, but a low turnover in comparison. Cleco, on the other hand, seems to be driven by all the right numbers. They have a better times interest earned, similar return on equity, and are driven by a higher turnover for a much smaller amount of risk associated with leverage. In comparing these industries, I found some similarities among the industries, those being Similar operating margins across all companies in both industries, and no substantial difference in return on equity. Some differences in the industries were that the electrical services industry uses a lower turnover, has a lower interest burden, and sustains a higher tax burden as well. They also seem to use higher leverage also. So narrowing it down to the top three companies, I chose Cleco, Cabot, and Exxon. Cleco has the lowest return on equity. They take on the highest amount of risk. They have the lowest turnover and median operating margin. It pays double the amount of dividends as Cabot, but has the half the price earnings ratio. Cabot has the second highest return on equity, the second highest risk, and the second highest turnover. They have the highest operating margin, but the lowest dividend, and have the lowest earnings per share. The good part about their company is that they have a high price earning ratio, indicating the growth. Exxon has the highest return on equity with the smallest amount of risk and the highest turnover with the lowest operating margin. They pay the highest dividend. They have the highest the highest earnings per share, but the lowest price earnings ratio. In conclusion, I place Cleco in third place. Cleco is showing very promising reports on their financial statements. However, differences among industries makes them the least attractive among the top three. Their high amount of risk associated with their low turnover seems to be driving the return on equity down. However, their stable dividend payments, high relative price earnings, shows they have much room for growth. Current talks of acquisition of this company are in the works, as these numbers suggest being a good company for a larger company to gain market share. Cabot comes in second and seems to be a growing company that is making a big effort in maximizing productivity to increase their return on equity. Their small earnings per share and dividends compared to its high price earnings indicates that more money is being put back into the company to spur growth. The company seems to be pushing themselves in the right direction, using a smaller amount of leverage and a high profit margin to drive the returns up. ExxonMobil is a mature company with a good track record and a stable, predictable future ahead, coming in at first place. Its high turnover is favorable to the high operating margin of Cabot, which drives its high return on equity for a much smaller amount of risk. This makes Exxon a much more attractive company to an investor looking for a company producing a solid dividend that is going in the right direction for a minimal amount of risk. For this reason, I chose Exxon as the best investment among the 10 companies chosen. Once again, my name is Harrison Ringwater, and thank you very much for watching my presentation.